Welcome to Breakout Investors. Today we are speaking with the management of Dolphin Entertainment, ticker DLPN. Joining me on today's call are Breakout Investors Brad Steveson and Aaron Warwick. This call is being recorded on July 26, 2021 and will be posted on Breakout Investors YouTube channel and on our Calls with Management podcast, which can be accessed via Apple Podcasts, Spotify, Audible, or wherever you get your podcasts. Supporting materials and discussion is and will continue to be posted on the Breakout Investors discussion app, which is located at app.breakoutinvestors.com. The application and much of the research content is free. After registering and logging in, use the search bar at the top right of any page, type in the ticker, and the results will give you a link to the research and discussion relating to today's company and today's presentation. Those of you already on the Breakout Investors platform can share your questions for the company using the Discuss tab in Brad's breakout room. So let's get started with me handing over the microphone to Brad, who will speak briefly about his interest in Dolphin and then introduce and turn the call over to management, who will present for about 15 minutes, and then we will be open for Q&A. Brad?
Thanks, Scott. And welcome, Bill. Again, good to talk to you again. I think we last spoke 5 or 6 weeks ago. Myself, Aaron, and Florian. And since then, a few things have happened. We have recorded a couple of podcasts on the company, just discussing our interest in your company. And then also, Aaron has written a very fine Seeking Alpha article. I don't know if you had a chance to see that. And so that prompted some collaboration in our community of Breakout Investors. And so we've been collaborating, and some new questions, of course, have come up as more people have kind of joined in the discussion about Dolphin. And so we had some follow-up questions for you. And so we really appreciate you coming on so that we can talk about that. But before we start with those, I wanted to give you a chance to give an overview of the company to those who may be new to the story that are joining us or will be listening to the call later today.
Super. Well, I'm happy to do it, and thank you all for inviting me. I appreciate the opportunity to share the Dolphin story with a wider audience, and appreciate the time. So I'll keep this to 15 minutes or less for those who are maybe not as familiar with the Dolphin story. I'm happy to share my screen. We'll see if this works. And let's see, how are we doing now? Can you see my slideshow?
I don't see it yet.
Oh, that's not good. Well, I'll give it one more attempt here, and if not, I'll just speak to it because there's nothing incredibly special, but I was hitting the share screen. No, we're gonna have it now. Let's see. How are we doing now? Does that work?
It works. Yep.
Perfect. Bam.
Yep.
Look at that on the fly. So obviously our forward-looking statements, but just to give a quick sense for those of the again that aren't as familiar with our story, Dolphin Entertainment is a company I founded back in '96, and the first 20 years we were primarily a financing, production and distribution entity for content, primarily television, but also some feature films as well. And most well known for our family content. We were a longtime partner of Nickelodeon, made a couple of different feature films, including a Justin Bieber documentary, a co-production with Mattel, etc. Back in 2016, had the idea to put together a group of leading entertainment marketing firms with the intention that we could take advantage of the strong tailwinds that the move to direct-to-consumer was experiencing in entertainment. The studio had announced they were going to pull their content off of Netflix, and it didn't take much foresight to see that there would be what are now called streaming wars, where each of the individual studios would have their own streaming platform. I reached out to a company called 42 West, which is widely considered the most well-known, most powerful PR firm in Hollywood, and they expressed an interest to combine with Dolphin and take the company onto NASDAQ. We closed that deal in 2017, and immediately applied. At the end of the year of 2017, we successfully uplisted our combined entity under the name of Dolphin Entertainment to NASDAQ, with a 3-year plan to acquire other entertainment marketing companies that would want to be the sister agencies to 42 West, and cross-sell services. During the past 3 years, then we've reached the goal of 6 acquired companies, and I'll briefly describe each. One is, of course, 42 West Starts, primarily has divisions dedicated to representing celebrities, talent. That's true, and we're very proud of that division. Many well-known celebrities we represent, from the Tom Cruises, Tom Hanks, Meryl Streeps of the world. But I think 42 West also is extremely well-known in Hollywood for its content marketing division. As you can see on screen, if you're able to see it, at the Oscars, 49 nomination campaigns, 9 wins, more than any other 2 PR firms participating. Last year at the Emmys, 145 nominations and 43 wins, including a history-making sweep of all 7 comedy categories. They're really at the top of their game. With 42 West, then we brought in Surefire Media. It's the industry leader in music PR, and a very large roster. We believe the largest in the industry. Musicians spanning every major genre of recorded music, routinely receives more than a couple of dozen Grammy nominations and many winning campaigns. In 2020, that included 7 Best Album categories. They're a very nice complement to 42 West, having film, television, and music. We also added The Door, which is the leading celebrity-based food and travel hospitality PR firm, and with celebrity chefs from your Rachel Ray's and Robert Irvine's to many of the leading food events in the country, live events, including South Beach Food and Wine, New York Food and Wine, for many years, Windy City Smokeout out of Chicago. That was also a big draw for us for Surefire. Their music roster may include Bruce Springsteen to Chance the Rapper, but they also represent many large music events such as Super Bowl Music Fest or Summerfest out of Milwaukee. The last year of the power rankings of these PR firms, to give one last context statement for them, the New York Observer ranks the 50 most powerful PR firms in the country out of all 12,000. Our 3 all made the top 50 list, which we believe was first, and they're all in the same industry, which makes it even more remarkable. 42 West was the most powerful entertainment PR firm, number 4 on the total list. I believe number 1 was a political lobbying firm out of DC. To those 3 cornerstone PR firms that span the breadth of entertainment, we added BHI, which is a boutique video gaming, esports, entertainment consumer product company, very well regarded, over 30 years in business, and they're now a division of 42 West. We added Be Social, which is a leading influencer and social media marketing firm out of Los Angeles. They also, like our PR firms, have 2 divisions representing both brands as well as the influencers themselves. That was the most strategic acquisition, I would say, once we had the PR firms, because in the world of earned media, PR and influencer marketing today are the 2 legs you stand on. And I don't think I need to tell anyone on this call the importance of being able to market online. So I'll leave it at that. And then, of course, we're very proud of our last company, Viewpoint. They're a full-service creative agency, most well-known probably for producing promotional videos in the television world. Longtime clients, HBO, Showtime, Discovery, A&E, ESPN, and we can use those promotional videos across all of our services for our companies. So here we are with Dolphin, the core collection of companies, and since 2017, we've been pointing to 2021 from the very first road shows prior to the uplist. The point of putting this collection of companies together, now that we have the reach and the scale that we want, is for what we've started now, which is to start owning some assets that we're also promoting. We call that evolution, jumping from Dolphin 1.0, our core businesses, to Dolphin 2.0, where we can create assets that we own that we can also market. This is the sole reason why the owners of these very successful private companies would agree to join into a public company, because the upside, of course, of asset ownership is a multiple of what it pays to market those events or those content. So back in March, we announced the first of those types of initiatives with the fact that we would get into the NFT business, really starting at the end of the summer, when the marketplaces for NFTs can accept credit cards. Happy to talk more about that after these opening remarks, since it's the day is now here for that as of last week. And NFTs represent an example of the type of 2.0 initiatives we will look to launch. Simply put, we are looking to own assets where our form of marketing and our ability to market will most influence the success of the product. So it's kind of common sense, right? We're not looking to get into the build electric cars business, because I don't know that our form of marketing or our reach would be as helpful. But in the vast majority of products, excuse me, earned media is the entirety of the marketing plan, because most products can't afford a paid media campaign. And in the world of earned media, that is the province of public relations and influencer marketing. NFTs are a sweet spot for us, because we can also utilize our relationships with intellectual property owners. Think the studios, the streaming services, every major streaming service effectively. The vast majority of them are clients. The major music labels, all forms of entertainment provide IP that we can develop NFT marketplaces or NFT products around. We know how to produce them with our production background and our access to the best artists of Hollywood, and we can market them. So we're used to marketing entertainment-related collectibles and consumer products. We have the best in the business at doing that. So that's an example of why NFTs rose to the top and were one of this year's 2.0 initiatives. But they're not the only one. We've committed publicly that before the end of this year, just like we said 3 years ago, we would buy 6 companies to finish 1.0. By the end of this year, we'll have 6 2.0 initiatives announced. Our goal is to have 2 per category per year. What are the categories that we see of products that we think we can market effectively? Well, consumer products would be one. NFTs fall into that category for us. And when you think consumer products and you think entertainment, there are many categories where historically entertainment or celebrity-backed consumer products have done well, and in areas that we currently market. The Door, for example, we think is the best PR company in the country for liquor. Celebrity-backed liquor or entertainment-backed liquor is well documented to have succeeded, whether it's Clooney and Casamigos or Ryan Reynolds and Aviation Gin, or pick your favorite example. There's a category that I think we're exploring very seriously to create consumer products. But beauty, cosmetics, and fashion, these are all categories where entertainment-backed or celebrity-backed products have done exceedingly well, and the list goes on. I think you'll see some heavy exploration from us in those areas. A second category that we'll make 2.0 announcements before the end of the year is in our legacy content business. Obviously, with the power of 42 West, We think we have tremendous reach to the streamers and the other buyers of content, as well as the ability to hopefully market it very well. So this could be independent film, this could be television, it could be podcasts, it could be documentaries, it could be all forms of content, and we're excited to share some of our opportunities in that field. The third category of 2.0 initiatives that we intend to roll out over the ensuing years would be live events. I made it a point to share the expertise of our marketing agencies in live events, whether it's music with Surefire, culinary, we're extremely high on with The Door, or even esports live events with BHI. Those are just in their baby years right now, and we think that with our combination of being able to bring content to the live events, celebrities to the live events, we're used to marketing those on a national basis, not just local. And then finally, with our influencer marketing, to be able to geo-target influencers that will promote the event, we could do exceedingly well with those. The last category of 2.0 opportunities we see for ourselves would be to take equity in other people's companies, especially companies that are doing either consumer products, content, or live events. There are quite a few companies that are looking to go public that, for example, that would want a large scale across the entire breadth of pop culture marketing campaign to let the world know of their company or their product. And if it's something we think we can market well, we may want to take equity in that company as part of the consideration for our services. So that's very briefly an example of or a description of the 4 categories of 2.0 initiatives we expect to launch in the ensuing years, and we'll have 2 announcements in each of the categories this year of consumer products, content, and equity. I think to briefly touch on it too, on some of the financials, it's also a pivotal year for us because we're going to have great top line growth and hit a milestone most microcaps traditionally struggle to hit, which I'll mention on the next slide. We do expect to cross 30 million in revenue this year, up from 24 last year. We think we're at a very attractive price at the moment based on that revenue. And our balance sheet, this goes back to the milestone that we're very excited to achieve this year. You know, we were an acquisition strategy for 3 years. We incurred debt to buy those companies. Our peak, December 31st, 2019, I believe, we had a working capital deficit of a little over 15.5 million. That's been reduced to 4 million as of March 31st, and we believe, and we're on track to have a working capital surplus this calendar year. So we will be that rare microcap company with a working capital surplus. We already have more cash on our books, almost triple what we had a year and a half ago, and our debt's been reduced by 25%. We expect to have more cash on the books than debt when we next report. And the debt's a little misleading since it includes 3 million of PPP loans that we expect to be forgiven. So we're quite excited for those metrics. And in conclusion, we think of ourselves as a profitable working capital surplus microcap company that's growing with our 1.0 companies cross-selling their services, and with the optionality and the upside of 6 to 8 catalysts a year in Dolphin 2.0. So there's the overview, and I hope I hit it exactly on the 15-minute mark.
Hey, I think you were about there, and that's great. We would forgive you if you went a little over anyway.
Okay.
So thank you for that. Probably the biggest question that has come up since we introduced Dolphin to the community is, why would an event owner give up ownership to Dolphin as opposed to just paying you to do like they're doing now, just paying you to market and promote the event?
Sure. They are not, they are, I should say, mutually exclusive. We are seeking to start events in markets where we don't currently have a client with an event. So there are probably 70 or more demographic areas in the United States, for example, large enough to support a food event that could draw 2 to 3, 4 million of revenue over a 4-day weekend, and we currently promote in less than half a dozen. So we tend to do the leading large-scale events in the country. We could create a number of sticking to food events for a second, and there's no shortage of markets where we could take it to. So we won't compete with our current clients. We'll expand the offerings by starting our own events.
Okay. And so when you start your own events, would you own the events outright, likely, or would, in other words, creating something brand new that doesn't exist yourself, or would this be something that you do a joint venture with someone else, or perhaps take some ownership in something somebody already has?
Yeah, our initial thoughts are to start something ourselves, bring in the last company we have not yet purchased is a live event production company, somebody with the experience to put on a South Beach Food and Wine or New York Food and Wine, everything from the locations, securing the location to the permitting. I'm talking the actual physical production of it, much like we have that experience on the film and television side. We could either buy a company for that, or in today's market, as you might expect, there's a lot of great talent out there that are currently unemployed in the live event space. So we could build it as well. And in this area, we could see ourselves launching with our market testing, let's say a food event in Memphis, Tennessee, that doesn't currently exist in the market, bring some of our celebrity chefs to it, give it some national recognition as well as local, and then upon success, roll it out across the South the following year to 10 different cities. That's the type of thing that I think we can own and would do very well with that type of structure. That's not to say, though, and it's a great point you're making, Brad, we couldn't take an event that's currently only in Brooklyn, let's just say, and doing well, but the owners have no interest to expand. They don't want to do that, and maybe they're even looking to exit. And maybe we purchase the event because we know we could take it to the other markets. So it really opens up both avenues for us, and it really comes down to our market knowledge, knowing which events would be that other markets would be receptive to and that we can market to.
So Bill, one of the questions that I had, I think it's, in the same strain of thought, is that your core competency up to this point has been the promotion of events, but not necessarily having to evaluate, the economics of these events or of different products and having an equity stake. So could you explain a little bit, why you think you guys can transition into that so well? Sure.
Early in my career, I'm 52. So I remember when I started Dolphin in '96 as a young producer and finance partner for some of the networks and studios, when the studios, and this will seem hard to believe, when they invited their CMO to the Greenlight Committee for the first time. Now, we take it today that you would have your marketing specialists at the table before you decide whether you're going to invest in a large-scale movie or an event of any type. And quite frankly, oftentimes marketing can drive those decisions. I think one of the most appealing facts of Dolphin to the CEOs and the senior management teams of each of our publicity and marketing firms is the fact that they, in their mind, get to decide what to launch and how to launch it, because they often see opportunities that for whatever reason in other environments aren't taken advantage of, or their opinions are overlooked in a fit of enthusiasm. Like something, this won't work. We're going to struggle. We're going to get a lot of blowback, et cetera, et cetera. And I think when it comes to the types of products we're looking to own, marketing may oftentimes be the single biggest factor. I think putting the program together, knowing how to market it, and by program, I mean the content of a live event, to me is paramount. And then you go hire people that can run the event well. But that's our view. And having been on the other side for my first 20 years in business where I produced the content, I can tell you that I went and brought in all these marketing experts, because in today's world, I don't think there's any success without the ability to successfully market to the consumer directly.
And I appreciate that. What do you see as some of the risks for you guys in this area?
Well, I guess each section of our evolution comes with people raising what's the high level concern, right? And when I was on the road 3.5 years ago, before we uplisted, I was asked repeatedly prior to the uplisting and then all of 2018, what makes you think that these private companies will join? And the biggest concern then was, well, can you even build a supergroup, is what I'm trying to say. The knowledge there was that these private companies absolutely would want to join, because having been a private business owner myself, you can grow your company faster if you're within a collaborative environment of equals. And that's proven true. The second concern was, well, you took debt, will you be able to pay it down quickly? That's why this year is such an exciting year for us, and we're really pointing to our financials in 3 weeks and then again in the third quarter. I think today at a high level, we knew we would, in other words, at a high level, content or live event ownership is a risk reward balance. You don't know that the event will work. That is true. You don't know if any one piece of content will work. If you did, you'd play the stock market, right? Joking with this crowd. But that's where, on balance, a track record and experience, I think, matters. Dolphin was a successful private company at producing content. We did it successfully, and it gave us the capital to do this venture and take it public. I think if I were to bet the jockey, and I'm not talking about myself, I'm talking about the senior management teams at each of the PR firms. If I'm going to launch a music live event and the senior management team at Surefire are behind it, then I'm pretty excited for it. And the same with food and esports, et cetera. Same with content, same with consumer products. If we're going to put a new liquor in the market, I want the senior management team at the door, not just excited to do it, but guiding it. Let's hear what their best idea is. And I think that's the premise of Dolphin, that we're going to take calculated and make calculated investments based on very, very educated guesses.
Yeah, and I like that you pointed out this was important for me when I first started learning about, like, this isn't something an idea you just came up with the last year or two. It's a vision that you had going into this to get to this point. So I appreciate that part of the story as well. I think that was important background for me.
I could jump on that 1 second, just maybe give one. Yeah. When it comes to 2.0 and the different categories of, what do live events, content, or consumer products have in common, then I'll try and simplify something, but it gives a flavor. I think if you're going to launch a consumer product to market, whatever it is, you have 3 core functions you need to be able to do. You have to be able to produce the product. You have to be able to distribute the product, get it to the consumer, whether retail or whatnot, right? And you have to be able to market the product. And in our motion picture or television world that I come from, if one company does all 3, they're called a studio. If they don't, then they're called whatever function that is, a production company, a distribution company, or a marketing company, right? We're not seeking to be a studio of other consumer products. We're a marketing company, and with certain products, we can produce the product also, like an NFT or like a film or television show. We'll always partner. But what I think with distribution or potentially production, et cetera, but let's take liquor, for example. I mean, in this case, look at the strategic advantages, or I guess what I'm trying to say is how educated the information is that we can access as a leading liquor PR firm. And as just an example of any of these categories that we're talking about across any of our companies. You know, the Door is extremely well known in that industry. It is the leading PR marketing firm. And so the relationships run deep, both with the different producers in that industry called distilleries, and also with the various distributors. The largest liquor distributor in the country is Southern Glazer. They are the sponsor of South Beach Food and Wine and New York Food and Wine. Who promotes those? The Door. Daily, weekly calls between those two companies. You have a lot more than just marketing experience. You're sharing future market insights. Which flavored whiskey is going to be pushed hard in summer of 2022? Where is the next gin flavor going to come from? Which regions of the country are adapting ready-to-drink beverages before other regions of the country? Which distributors in the Northeast are outperforming their peers? Which distilleries are having cash issues? Which ones have over-delivered in the market? This isn't just, oh, let's make a gin and slap a celebrity on it. Right? This is coming with a lot of very high-level premium partnership type collaborations, and you come in with so many advantages when you have those relationships. And the closest I could equate it to is, you know, making a movie off well-known IP in my world. It's no guarantee of success when you adapt a movie from a book that's been a mega seller, but it gives you a heck of a lot better chance. I would argue that when you have, if you're at the very best in the business at any of those three functions, production, distribution, or marketing, you give yourselves a much better chance of success. And there's certain product categories where that marketing is more important, or certainly equally important than either of the other two. Just like there are certain product categories where the actual production of the product is most important. We're looking for opportunities, and there are many, in categories where the marketing is the most important, and specifically that our companies are very good at marketing those products. And I think just kind of sharing those insights gives you an example of what we're talking about, and the types of partners we go to market with. We wouldn't just, you know, partner with a distillery and make a couple of cases of gin and hope for the best. we would be going to market with national distributors with a national marketing campaign, and then you can see where the Door on its own will be a driver of that particular type of consumer product, since I use that as my example. But look at how beneficial it is that they're within the supergroup. If you wanted to launch a gin, do you think it might be worth a conversation with 42West to do it with the PR firm that represents James Bond? That would be a pretty fun collaboration for a Shaken Not Stirred, right? Or do you want geo-targeted influencer marketing because you're putting your product in the Northeast first? Well, let's go identify, you know, the top 100 influencers in that space that live within a 30 square mile radius of New York City with Be Social. Or how about, do you want a celebrity fronted liquor? Is that music with Surefire? Is it film and TV with 42S? Do you see where I'm going? And I think that's where also, yes, the inside knowledge of whichever marketing firm is driving a particular type of product, content, or event is critical. But the fact that they're within this group gives them a unique advantage against even their one or two other competitors. that's our thesis.
Great. Brad, you have some other questions, I think?
Yeah, sounds exciting. So overall, let's say you pick a bad event, or you create an event that just doesn't go well for some reason. What are the risks to you? It sounds like you're going to fund that primarily with sponsorships. Am I hearing that right?
Yeah. We are only taking calculated bets. We're not, let's bet the company on a single event or product. All of these 2.0 initiatives are anywhere from $500,000 to, I'd say, high-end $1.5 million, $2 million at most cash bets. And in some cases, it's a $0 cash bet. You know, we can take equity in other people's companies for providing services or for expansion of our services. And we'll have the opportunity in any of the categories to lay off our bet. Project finance in entertainment has taught me that for 25 years. There are many products where we didn't put up a penny and we took 50% instead of 100%. So we'll make educated decisions based on early market data of how much of any one product or piece of content do we want to own in relation to that type of knowledge. So this type, I equate the 2.0 initiatives very much to the project finance that I did with Dolphin from 1996 forward, where you put a business plan together for any initiative. You see the equity needed to get it off the ground, again, $500,000, $1 million, whatever it may be. And then you decide, do you put up all the money yourself? Do you go 50-50 with a partner? Or do you lay it off and take less of an ownership stake in it? Those are the types of evaluations we'll be doing on an individual basis. Something like NFTs, those are very, very inexpensive to produce. And what's beautiful about any type of digital product, for example, is you make the NFT once and then you can replicate it. And so that's obviously something we don't need a financial partner for. And we would look to, now we'll have intellectual property partners, people that we take or develop NFTs for, but we don't need a financial partner.
Could you maybe talk a little bit, Bill, about how Dolphin 2.0 and those initiatives will work with like Dolphin 1.0 with what you've been doing historically? Does it cut into any of the things that you're doing there, or is it sort of just neutral, or is it, does it actually create benefits to your underlying business?
Sure.
As well from the past?
We see it as very additive. Let me go back. Because 2.0 initiatives by nature often will touch literally every company in the supergroup, or the majority of them. So I can give an example. Let me go back to live event, although it applies to content and consumer products as well. Let's say we were to do that food festival in Memphis. I don't know why I keep picking Memphis, but hopefully they want a food festival. And let's say that's an event that has a $500,000 budget to roll out to start, and then it'll expand up as you sell tickets and you buy more food, et cetera. So maybe at full cost, it's $1.5 million. Of course, you've got sales against it to go there, but let's say, and you're looking to run an event like that hypothetically at a 20 to 25% margin. So let's just use easy math. Let's say then we do $2 million of revenue, $1.5 million of costs. Now, $500,000, hopefully that's relatively exciting for a single event, but it's exciting to us because it's scalable. You can go to 10 cities the next summer. Now you're starting to get a little interesting again for a company our size. That's pretty neat. But it would be misleading to say that all we're doing is making $500,000 in success. Why? Because that event needs a PR firm. So inside the budget, we give ourselves a third-party PR rate, right? We're the owner, so it's how so the door is getting a PR fee. That event will need somebody to produce it. That would be our live event production company that we either build or buy. That event will need influencer marketing, and we would pay Be Social. And that event would need Viewpoint to create branding and a creative agency. So you can either look at it like we're operating it as a standalone budget for our own, best practices and see how we would want to best spend the $1.5 million. But within that $1.5 million, we're also creating a client for 4 of our 6 agencies. So you could also instead say, well, instead of operating at a 25% margin, maybe we're operating it closer to a 50% margin. And that's exciting for us. And that's a good example, I think, of synergies and how they help the 1.0 business. Because, I would say that the 500,000 represents the profit under 2.0, and I would say that event's creating clients under 1.0 for our agencies. The other thing that we haven't socialized, but if we wanted to kind of predict in the future, if in 2017 and 2018, I spent a lot of time answering why I thought companies would want to join. And in 2019, I was answering questions of how fast we were going to pay down the debt. And here we are effectively out of it, certainly this year, I mean, and really being able to focus on 2.0. I think, and Aaron and Brad, you had said something earlier that really, you've picked up on it faster than others in the market, but it's definitely true. 2.0 has cross-selling too. I've never made a big deal out of that because I'm just trying to explain 2.0 to people. But pick any partnership we have at any of our clients. Like, let's just say, hypothetically, we started an NFT program with, pick a sports league, right? One that we don't have, right? So people are familiar with Dapper Labs and doing NBA Top Shots, and they've done a great job and have a great product. Let's say we were to start an NFT program with one of the sports leagues, hypothetically. Well, of course, it's an NFT program, but using a sports league as a proxy for any intellectual property partner. But what would stop us from making content? Be it documentaries, be it podcasts, be it whatever around that type of partner. What would stop us from launching other consumer products? What would stop us from doing live events with that partner? So any one 2.0 idea can spawn sister 2.0 opportunities, and that's where you can start really multiplying each relationship. So I think that probably be more in the focus in 2022 and 2023 as people see the different 2.0 initiatives being announced. We have 5 more coming this year, and they'll start saying, well, could you do an NFT with this group over here that you're doing content with, or could you make some consumer products with this group over here? So I think that's pretty exciting for us too.
Sounds like it. So I think I heard you reaffirm you were expecting 6 total new initiatives to be announced in 2021, including the NFT initiative that's already been announced. Did I catch that right?
That's right. Yeah, it's going to be a little bit of I know that'll seem like a pretty quick pace. Although I will say we spent the first 6 months of this year prepping for those other 5. So it's coming out pretty quick.
So I wonder if I can put you on the spot, and I understand if you can't answer, but I think you thought you might be maybe able to announce 2 of those before the August earnings call. Is that something you can still confirm or not?
I've been instructed not to. I know I can't comment prior to the earnings call. I will say, we're extremely confident on the 5 before the end of the year, and you can infer from that we believe we know what we're intending to do. It's not like we're going to go searching for those partners or whatnot. Sometimes, though, when you have a couple of initiatives, especially on the equity side, that involve partners, you want to be a good partner to them, and sometimes that means doing the timing on their timing. So whether we get 1 or 2 before this earnings call or they come very shortly thereafter, it's not always something on the timing that we want to be slaves to an earnings call, but we are highly confident in the 5 before the end of the year.
Okay, thank you. NFTs a little bit, just can you explain a little bit how the typical NFT deal will work? And what I mean by that is, obviously you've got an artist, and I don't know, do you split with the artist? Who else is involved in the economics of it? What's DLPN's share? How does DLPN get paid? Can you talk a little bit about that?
Sure, and these are early days for NFTs, as you can imagine, right? So but it does follow some rules that we have across entertainment and sports developed over the last few decades, right? It partly depends on how many partners there are in a product. So without getting into specifics, like let's take our NFL Hall of Fame product. We're obviously partners with Hall of Fame Village for those NFTs. There are individual players involved that would also get a piece of the revenue share. So and happily so. And so there's an example of a product that has 3, let's call it major partners involved. And without getting into specific revenue shares, you could probably infer from that roughly how we're looking at that relationship. But there are other NFT marketplaces that may not have 3 partners, but only 2. We may start an NFT marketplace with just that doesn't have the that might be hypothetically, if we were to launch one with a film product, we might just only have a direct relationship with the studio, for example, or something like that, where we're not involving players, or if it was animation, the animated characters don't get a cut. And then there are certain marketplaces where we ideate the concepts. The culinary NFTs certainly fall within that world. This is an NFT marketplace that Dolphin is in the process of developing, and will launch to the market as a under our own consumer branding. I'm not saying it'll be called Dolphin, but we'll develop a brand for it and bring it to market. Now we'll partner with individual chefs for individual NFTs, but we would own a much larger percentage of that marketplace. One could infer the majority or more, or 50% or more of each of those individual sales. So it really depends on each partnership and the value of the underlying intellectual property that's being brought to us.
Okay, interesting. You mentioned earlier about Visa working to settle crypto transactions. Do you have any updates on that?
Yeah, the crypto marketplaces. We've been waiting, as has pretty much the rest of the market, to launch large-scale consumer-facing NFT programs for the day when you can go to the broadest possible audience, meaning can the consumer pay with a credit card. That's now available as of with major platforms. We feel at scale as of last week. We anticipate having a partnership with a platform to announce very shortly. You can infer from that, presumably before or on the earnings call. And that platform will be chosen because they can accept credit cards, as well as potentially fiat currency. So you can pay not just in US dollars, but since NFTs, to maximize the fullest potential of NFTs, and with the types of partners we're attracting to our NFT marketplaces, these are global products. And so you want to be able to have people pay in whatever the native currency is. And sometimes that might be crypto, but in other cases, it might just be the euro or the Canadian dollar or whatever it might be. So to be able to pay with credit cards or fiat currency or crypto is important to us, and we're excited. And I think now what you're going to see in the market, if I were to predict, not just from Dolphin, but from the market as a whole, is you'll start seeing the studios come in, the major music labels come in, because NFT programs can be sold to all of their existing customers now.
Great. Well, let's see. I had a couple of financial questions before I ask those. Aaron, did I miss anything we should ask about?
I don't think so. Those are the only other questions I have as well.
Okay, a couple quick ones, and then we'll. I think we'll be done, Bill. The earnouts. You have earnouts. I think with some of your purchases that you've done, or acquisitions, I should say, that you've done with the super groups. Can you talk a little bit about how those work and what impact they may have on financials, and for how long?
Sure. Well, let's see. I think of our acquisitions in order. So probably the headline statement we made on our Q1 earnings call, and I'll reiterate Q2, is that the earnout and the cash payments to the CEOs of 42S have been completed as of March of this year. That was a balance sheet item for 4 years, and We owed $11 million over those 4 years, and we've paid in full as of March. So there's no continuing obligation there, and that's one aspect of the liabilities on our balance sheet that we've already cleaned up, or finished paying, I should say. In terms of other earnouts, we have the Door, Be Social, and BHI all have ongoing earnouts. The Doors will finish at the end of this year, and then BHI and Be Social at the end of next year. But with full earnouts being met, I think we have 7.6 million shares outstanding today. It would take us to less than, we'd still stay under 8 million shares, even with full earnouts being met. So it's not a very large overhang. And of course, we want them to hit it. Our numbers will, will reflect that, and we're excited for that.
Great. So in your other income section, and I know these are overlapping discussions here, but what is, when I go through gain on, when I go through change in fair value of convertible notes, loss on deconsolidation of Max Steel Vi, change in fair value warrants, put rights, and so forth, what is remaining in that section that we would see going forward, and what's gone? Is that something you have right on the top of your head?
Sure. Yeah, this goes back into what we'll continue to make a meal out of on our earnings calls, because 2021 was such a great year for all of that, since many of them either expire or have been paid off in full. Warrants, we're down to only 20,000 warrants left in total. Obviously, that's 20,000 shares if exercised. So all the previous warrant overhang has expired. Which is great. The puts I just mentioned have been paid off in full. And I believe fair value of any convertible notes, the convertible notes that we had entering the first half of this year, all but one have been converted. So we're really, there's only one note left that is being fair valued. So that's nice. We have some notes that are not fair valued, and so that means we can mark them to their actual principal amount. But they're all long term, which is also great. So that's also helping us with our working capital. And I think those are all the variable instruments.
Yeah, I think that's it. Yeah. That'll make it easier to read from now on. So I'm glad about that.
Yeah, exactly. We got that comment too. A few people, boy, it's much simpler now. I said, yeah, it's great.
Yeah.
It's also nice to have more cash than debt, right? Including term debt.
But I like the way the way you structured things to give everybody skin in the game and motivation to come together and do what you're doing to succeed. I think that was a very, very wise move. So I think it's great.
Yeah, all of our CEOs have equity, and we've had on the books now an employee stock option plan that we're excited for this fall to incentivize all of our senior leadership and everyone in the company, for that matter. So this thesis will work if we collaborate and help each other launch these 2.0 initiatives.
All right. Well, thank you. I think that's all we have.
Thank you, Bill.
No, thank you guys. And I really appreciate the time to speak to you and your audience. And I know your audience knows this, but the amount of time you take to understand our story, I assume, is the same amount of time you take to understand the stories of other companies you're interested in. And you just do not see this in the marketplace. Certainly in my 4 years of being a CEO, building a micro cap company, hopefully into a small cap company pretty soon. It's impressive. And I appreciate the effort you make to really understand companies, and I wish we saw more of it. So thank you guys very much.
Yeah, thank you. And we'll be posting it, later today or soon on YouTube and as a podcast format. So we'll get it out to more people that can't join. We have a lot of people that that during the workday they can't join. So.
Well, and if I could, for anyone that would like to, I mean, we're happy to put anyone on our mailing list. If you want to see our earnings release and hear about the times of our earnings calls, et cetera, I think that'd be great. And it could either be sent to right on our website or to James at Hayden IR. And we'd love to get the word out there. So thank you guys very much for that opportunity.
Thank you, Bill.
Okay.
Thanks, Bill.
Bye, guys.
Bye.
Some or all the speakers may maintain positions in the securities discussed in this podcast. The views in this podcast expressed are those of the speakers, not Breakout Investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Neither Breakout Investors nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information presented by this podcast and any liability, including in respect of direct, indirect, or consequential loss or damage, therefore is expressly disclaimed. No one on this podcast is an investment advisor, and no one is providing investment advice. Before investing in any company's stock, you must do your own research.